So I had a couple of buyer consults last week where the issue of pre-qualification came up, or pre-approval or conditional loan approval. There's a bunch of different words for that. Oftentimes they're used interchangeably. But this is arguably, as an upfront effort, one of the most important things that a home buyer can do. And the confusion about these terms and what they mean is pretty significant. Also, there's quite a tremendous strategy involved if you complete this process correctly. So I want to define a few terms and correct a few errors along the way. All right? So first of all, the pre-approval, pre-qualification, conditional loan approval, whatever you call it, is basically all the work that's done by a buyer up front before they ever go out and buy a house. Okay? It really makes sense to do that no matter what, because you want to be making sure that you're looking for homes in the price range that you can qualify for. And also, it makes a heck of a lot of sense to make sure that the home that you'd like is something that you can actually spend money on to buy, both on the cash down as well as a monthly basis. But let's look into the details. There are basically three levels of work that can be done up front. Number one is called pre-qualification. Pre-qualification is a verbal conversation with a lender. Sometimes it might include a credit report, sometimes not. It never includes providing income documentation. Basically, a pre-qualification is a paper napkin discussion with the lender that basically says, yeah, this is about what it's going to cost, and if everything you told me is correct, you might be able to get a loan. It basically is the simplest, least intrusive way to have a conversation with the lender to kind of figure out, yeah, I think you could probably qualify for a loan. But let me assure you this, precisely zero listing agents and home sellers are impressed with the pre-qualification. The second level of advanced work is known as a pre-approval. Now, way back in the day, in the 1990s, when I first got into the mortgage business, a pre-approval meant that you took an entire loan file and took it to an actual human underwriter who went through everything and signed off on the loan. That was literally pre-approved before finding a home. Well, nowadays, it's a little fuzzier than that. A pre-approval typically will include providing income documentation to the lender, pulling a credit report, and submitting to an electronic underwriting process, but no formal loan underwriting approval is given. Based upon my experience, roughly 99.9% of all transactions go together with a pre-approval. But notice the key point on that. No underwriting approval from an actual human underwriter. What they do is this, is they take all the income documentation and then they type it in the computer. Pay stubs show this, income shows that, credit report shows this. They put that all into a computer, press enter, and Fannie Mae's version of this is called the desktop underwriter, and it spits out what they call a finding. And the finding is that you're going to get approved, or you're likely going to be approved. What it isn't is an actual approval. The key test would be this. If you've got what you think is a fully underwritten loan approval from a lender, you can ask them, what are the conditions of the loan approval? And you'll hear something like, well, we don't have actual loan conditions yet because you need to find a house and submit the loan with the contract and appraisal and all that to get your loan conditions. Well, that's the key. You don't have an approval, you have an electronic pre-approval, which is not quite as strong. And that brings me to number three, a conditional loan approval, or sometimes it's called a TBD approval. TBD meaning the property is to be determined. The conditional loan approval is like the pre-approval of old. And that is, you take the entire file, the pay stubs, the bank statements, the tax returns, everything, the credit report, you submit that to an underwriter who goes through and signs off on it, will provide a list conditions from the lender in order to close the loan. It literally is a loan commitment. And this is the important part. The typical lender, and I would say in my experience, probably 2/3 of them, do not like to do conditional loan approvals because that underwriter is a, I don't know, $250,000 a year person, and their autograph, literally their signature, is sufficient to release those funds. And the lender's going to want that underwriter not working on deals that haven't yet happened, but those that are already in escrow. But the key thing is, if you find a lender who will get you a conditional loan approval, you can literally go out into the marketplace with an approval in hand, effectively negotiating as cash. Let me show you an example. This right here, this is a conditional loan approval on a transaction that I did recently from a lender that I work with called Parkside Lending. And if you look at this 2-page, 3, 4-page document, it's got the underwriter's name right here, Sean Mackey. It has a full-on commitment from this lender with a list of prior to doc conditions, going on to 2 pages, and then a list of prior to close conditions. So this is literally the commitment from the lender to make the loan. So the borrowers and I, my clients, we went through and looked at all of these conditions to make sure that there were no conditions on here that we couldn't meet. Once we figured that out and we were satisfied, we were able to write an exceptional offer. The offer that we wrote didn't have a loan contingency at all. It was very important that my client's problem, which was they needed a loan, and literally that is a problem. If you don't have enough cash to buy a house and you need a loan, that's your issue. That's not the seller's issue. So we wrote the offer without a loan contingency because we already had the loan and we didn't need the time to go out and find one. And that effectively made my clients just as good as all cash buyers. Well, as you can imagine, the listing agent and the seller loved that, and we got the transaction accepted. Surprisingly, found out later, they were competing against a 50% down offer. So think about this. My clients were writing a 20% down offer. The competition was writing a 50% down offer. Now, typically you would think that a 50% down offer would be a better offer than the 20% down, right? Well, not in this case. The 50% down offer, they asked for a 2-week loan contingency. My clients, they asked for none. If you'd like to discuss this further, I'd be happy to help you. You can call me, 949-413-2371. You can also email me, michael@housemgroup.com. Thank you very much and have a great day.